The lifetime capital gains exemption is your ticket to becoming rich. Find out what it is and how you can use it in this video. The lifetime capital gains exemption. So we're going to start looking at what that amount actually is. So in your lifetime, you get a capital gains exemption of $1,250,000 for dispositions of qualifying property. So your taxable one is about $625,000. Your taxable capital gain is $625,000 or 50% of $1,250,000. All right. So everyone gets a one-time lifetime capital gains exemption. And this is a real big ticket savings for you. If you look at the tax savings down here, you can find that at the largest marginal rate. So assuming you're the highest bracket earner, you would save about $334,375. That would be $1,250,000 times 53.5%. So this is your capital gain. We multiply it by 50% to make it a taxable capital gain, and we multiply by that marginal rate at 53.5%, the top marginal rate, and you get 334,375. Now you can see why this is your ticket out from the middle class into becoming wealthy. So you can keep all that $1,250,000 that you make when you sell shares of your business. You get to keep all of it. You don't have to pay any tax. So that's $1,250,000 that would go straight into your pocket. Right. Now we need to figure out what is a qualifying property. And the qualifying property is this qualified small business corporation share. So this isn't for every type of business. It's for qualified small business corporation shares. And we're going to look at what that is momentarily. So this right here, before we even get into it, just so you know, on the CRA website, you have all this information. They have exactly what it is, who can claim it, being a resident, what capital gains are eligible, what is the deduction limit, etc., 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 and where you claim it. Here I took a segment out and you can see you claim it on line 254,25400 of your return. Okay, now getting back into what it actually is, what is the qualifying property? That is the qualified QSBCS. And this is what it needs to be. So it must be a small business corporation, okay, or an SBC for those of you that know about the small business deduction. This is for those small business corporations. The share must be owned by the taxpayer, the spouse, the common law partner, or the partnership related to the taxpayer. Okay, so let's say you're just the only person there. That would be shares that you own. The shares must not have been owned by anyone other than the taxpayer or related person during the 24 months before the shares are disposed of. So this is very important so that you're not just flipping shares. Okay, so these shares that you hold could not have been held by someone else in the last 2 years. Okay, very important. It will be denied if, for example, you have these shares, they were purchased maybe 12 months ago, then you try and sell it, it will be denied. Throughout the 2-year period, a minimum of 50% of the fair value of the assets must have been used primarily in an active business carried on in Canada. Pretty much what this means is you're not a passive investment company. You're using your assets to essentially carry on business. Okay, so most of you will meet this if you're an actual business, small business corporation, and you don't have passive income, or you're an investment company, corporation, just trying to make income like that. If you have active business and you are a legitimate business, then you will likely meet this one, no problem. Now, the problem is we must know what a small business corporation is. It is a Canadian controlled private corporation, or a CCPC, where all or substantially all of its assets are used in an active business carried on primarily in Canada. So again, you have to be a Canadian company, a Canadian controlled private company, so public companies don't meet this. And 90% of the assets must be used to carry on business. Looking at active business, so you're buying inventory and you're selling it. For example, that's one example. You're not just holding on to investments that are giving you dividends. That would not meet that criteria. Okay, so very important here. Let's take a step back. So you are a person who owns shares of a company. You own shares of your own company, your small business. Maybe you are a mechanic, okay, and you have your own mechanic shop. You want to sell your mechanic shop to someone else, so you sell the shares because you incorporated that business. You're going to sell the shares you own of that company to someone else for $1.25 million, okay? You are selling shares of a qualified small business corporation. Those shares are worth $1.25 million, and because you meet this criteria, you will be able to take your lifetime capital gain exemption, assuming you didn't use anything in the past and assuming you meet everything for the criteria to calculate it, which I'll show you in a bit. You will not pay any taxes. You would save $334,000 tax money that you would have otherwise paid. So you get to keep the 1.25 million as a whole. So we're going to look at the simplified calculation, figuring out what is the amount that we can deduct for our lifetime capital gains deduction. So you have your remaining lifetime limit, which is number one. So we're going to look at the least of the following three things. Okay. So the first one is your remaining lifetime limit of 1,250,000. Times that by 50%, that's at 625,000 taxable capital gains equivalent. Okay, so it's how much is remaining. So if you used it prior, then you won't get the full amount. If you've never used it, you get the full 1,250,000. So it just depends how much you've used in the past. So how much do you have remaining? The second one is your annual gains limit. Okay, so this is how much you have of the deduction remaining, how much you can use. This is the amount that you can actually claim based on the disposition that you have in the year. For example, you might be able to claim the whole thing, but that depends on whether you have a disposition for that amount. Annual gains limit is your A minus B, where A is your taxable capital gains from qualified small business corporation share dispositions in the year. So you need to have a taxable capital gain in the year in order for you to claim it. I.e., if you had remaining lifetime limit but no capital gain, this was zero, you wouldn't be able to claim it because the least of the following three things would be zero. B is your net capital losses deducted in the year against taxable capital gains only in the case where your net capital losses are greater and you have a difference. Okay, so what that means is, let's say you had net capital losses deducted of 20,000 and net taxable capital gains of 15,000. The difference would be 5,000. And assuming that your capital gains deduction here was just your remaining lifetime limit, that means your A minus B would be A 1,250,000 minus 5,000, that difference. And you would have 1,245,000 there, 1,245,000. And any allowable investment losses deducted in the year. In theory, if your net capital losses in the year are higher than your taxable capital gains and they're deducted against each other, that difference will bring back your annual gains limit. The last one is your cumulative gains limit. So this one's very straightforward. It's essentially your annual gains limit minus your CNIL, or your cumulative net investment loss balance at the end of the year. So CRA tracks this one for you in your T1. So you'll know exactly what your CNIL balance, if you have any, when you're filing. Usually this will be zero. It can be, you might have a balance if you are, let's say, deducting interest or having other sorts of expenses related to your investment. So for example, if you have a loan and you are deducting the interest on that, then you'll have a CNIL balance. That'll bring your annual gains limit down by that amount. So just to reiterate, you have your remaining lifetime limit, which is your 125,000, 1,250,000 minus anything that you've used in the past, any capital gains deduction you had in the past. Your annual gains limit, which is essentially how much of a disposition do you have in the year for your qualified small business corp, and your cumulative gains limit, which is your annual gains limit minus your CNIL. The least of these three amounts is how much you can claim as a lifetime capital gains deduction in the year where you don't have to pay any taxes. If this video helped, remember to like and subscribe. This really helps with the channel growing. Remember, this is general information, not personalized tax advice.